I joined Intel in September 2008, and I would always remember the time I joined Intel for two reasons. First, it was the first step towards paying my student loans, and second, while on my way to attend the new employee orientation class, I heard on the radio that Lehman Brothers have just collapsed. Millions have been lost in the 401k accounts, thousands of people are jobless, so it was quite ironic. Although I didn't know anybody who has lost money in 401k or who has lost a job, I was still filled with anxiety and despair because this could easily happen to me 30 to 40 years down the line. More so because I didn't know anybody who was in the United States that could guide me or that could help me get back again on my feet if I make a mistake. So when the new instructor asked me to put down a number in front of my 401k contribution amount, I chose to put a 0 and decided that I would learn the nuts and bolts of financial investments in the US before I feel comfortable investing again. In this speech today, I'll talk about 3 such investment vehicles that I believe everyone should be aware of because they are very common. The first one, stocks. The stock is the most common financial commodity that is traded billions of times each year on financial exchanges. But what exactly is a stock? A stock represents ownership rights. For example, let's say Intel floats 10,000 shares and you buy 1,000 of those shares. That means you own 10% of Intel Corporation. Many companies offer stocks because they want to raise capital for growth. In recent times, companies such as Facebook, Zynga, Groupon, Michael Kors have gone the IPO route, and millions of initial investors, not millions, but maybe thousands of initial investors have gained as much as 50 to 100% or even more by investing in those stock options. Stocks are considered aggressive by many financial analysts because they are very volatile. Your fortunes can change tremendously in a short amount of time. The second commodity that I want to talk about is bonds. Bond is essentially a loan that you give to an organization, and the organization in turn gives you a rate of return on your principal. Many organizations offer bonds, organizations such as government, corporates, or even municipal cities. The rate of return depends upon the risk you take on the loan that you give to the organization. The greater the risk, the more the return is. The most common bond that is out there is offered by the US Federal Treasury. In fact, its 10-year federal bond is bought by many developing countries such as India, China, because the probability of the US to default on its payment is very low. Many corporates also offer bonds, and in this slide you can see the bond offerings of AMD. This is the data from 2013. And the price of the bond was 100. It was offered at a discount of about $6. The coupon rate represents the rate of interest. Notice the difference between the rate of return of the US Treasury bond and the AMD bond. This is primarily because of the amount of risk that is associated when you give AMD your money as compared to giving it to the US Treasury Department. Bonds are considered a safer investment because they are stable. Not many companies have gone bankrupt and not being able to pay back on their promises. Now, if bonds are passive and stocks are aggressive, there has to be something in between. And that something is my third investment commodity, that is mutual funds. Mutual fund is essentially a mixture of stocks, bonds, and some other financial commodities that essentially reduces the risk in your portfolio by diversification. Many mutual funds exist today, and they are managed by professional investors, professional analysts for a small fee, and they give a decent rate of returns. The best example that I can give you on mutual funds is mutual funds offered by Intel Corporation in the 401k account, the target date funds, and the core funds. The target date funds especially are geared towards your retirement time frame, and the percentage of the distribution in the fund changes as you reach your retirement. Notice in this slide how the amount of money in stock changes. For the target date 2015, it goes down because the person is reaching retirement. you don't want him to have a risky portfolio, so his investments in stocks goes down. Whereas for the target date fund 2055, the amount of money in stocks goes up because there is still time for the person to retire. He or she can easily wait and take some risk. Now these are the three commodities that I wanted to talk to you about today, stocks, bonds and mutual funds. Now let's talk a bit about insider trading, which is actually a concept that can be used to determine if it's a good or a bad time to sell a stock. In recent times, the term insider trading has been associated with illegal conduct, where an executive gains by the use of secret information and selling his or her investments in the stock market. However, there is a legal aspect to it. Legal in the sense that a company executive is required by law to report his selling or buying of stocks to the SEC, Securities and Exchange Commission. And if you think of it, it makes sense because many times these upper level executives have information that is not common to the public and not even common to the employees of the corporation. And if you see that many such executives are buying or selling stocks at the same time, you bet there is something serious or dramatic going inside the company. In this slide, you can see the insider trading details of Intel Corporation. You can see our CEO Renee James is selling a lot of her shares at 26.50, and so is the TME president Bill Holt. This is all public information. You can get this information from Yahoo Finance, and it's all out there. Now, in conclusion, if I have to summarize my speech and give you one message, the message will be: take out the time to research your investments. Take out as much time as you do when you shop for a car or for a household appliance, because your present choices will very well determine your future. Thank you.